Goldman pays up for talent, sending profits down. The last 2 years, really since the onset of COVID, and then as we've seen the labor shortage and the labor gap between participation and the number of open jobs increase, has meant that companies have had to compete at a level that they probably haven't had to compete at for a long time. And this story here in the Wall Street Journal talks about how Goldman, and really majority of the banks, the JP Morgan Chase, Citigroup, their profits in Q4 were impacted quite severely by increases in compensation and these banks' ability or desire to keep their talent and then grow their talent base such that they can meet the demands that they've been seeing, which have been boons in trading and M&A activity and just deal flow. And so we've talked a lot, of course, about how businesses are having to compete at many different levels on many different fronts. And of course, certain industries attract certain kinds of personalities, and banking at a kind of stereotypical level is typically very profit driven, very monetary and financial driven. And the kind of people that end up probably working in banking have probably some level of interest in economic security for themselves. And so in order to hold on to their talent, because the individuals that work at large organizations have liquidity at other large organizations. So we've seen tech take a lot of talent from the creative services. We've seen tech take a lot of talent from banking and things like that. So in order to hang on to their talent, they've had to pay enormous amounts of money. I think Goldman said that they had to pay $4.4 billion more in compensation in 2021. JP Morgan Chase had to pay an additional $3.6 billion in compensation in 2021, and Citigroup had to pay an additional $2.9 billion in 2021. So enormous sums of money, but of course spread across an enormous employee bases. And what it's done is it's starting to impact profits, and this is one of those implications I think that is. For those who don't manage financial statements or balance sheets or think of organizations at a level where you're thinking about the P&L, we all think, okay, yeah, let everybody should make more money all the time. But at some point, what happens is it impacts profitability. And leaders of the banks, at least, are saying for the moment, look, there's real wage inflation. But if hanging on to our talent for the time being means it impacts shareholder value for the time being, so be it. I think that's a nice way to look at it for now, because the waters are so choppy in the labor markets, and the idea that you would bring down capacity as a function of the labor shortage has even larger implications, I think, on profitability long term. Because it impacts things like servicing your customers, and if your customers leave you for good, then that profitability will never return. In the same way that if you can, there are tactics you can do around headcount and things to make sure your profitability returns. The other, I think, unseen consequence of all this additional compensation going to workers, which is a good thing. I've talked about this before, but I do believe that people should try to make as much money as they can. And at the end of the day, for most people, the end goal is just economic security for themselves and their families. But what happens is that in paying people in above market rates for work, and then bringing on a bunch of talent to live up to growth, you end up getting a scenario, and I've talked to James Phillip and Dennis Theodoro on our JMJ Phillip conversations on the JMJ Phillip channel. What you end up getting is a scenario where if there's any downturn, any kind of pullback at all in the markets, or any kind of dip, for example, in banking, at least a lot of the boon for the last 2 years has been deal activity, M&A activity, investing activity. And if you project out this year, where the Fed is thinking of raising rates a few times, we should see activity come back as cost of capital goes up. And what will happen then is that these divisions or these parts of businesses that have grown significantly as a function of the last 2 years are going to have to pull back, and you're going to get into a situation where either those who are overpaid take pay cuts, or those who join the organization last typically are the first ones to get ushered out. And so all this movement over the last 2 years starts to look a little bit pointless isn't the right word, but it's almost movement for the sake of movement, and there's no sustainability to it. And so you get into a place where a kind of short-term ambition to make a few more dollars ends up biting you later. And we talk about that a lot on the J.M.J. Phillip channel, where in the restaurant industry, you have such a shortage of workers. The companies have had to cut hours by 10%. We were talking about McDonald's in that scenario, and you just get into this cycle of unnecessary movement, short-term movement that seem like a good idea for individuals, in the short term, but over a long enough time frame, and that's where careers happen. Really, the careers don't happen in 2 to 3 year horizons. They happen over a 40-year span. You've got to optimize your earnings potential over a 40-year time horizon. And the idea then that it's great to make a short-term move because the markets are so frothy right now, especially with this labor shortage. Inevitably, though, things revert back to the mean, and these moves might not be looked upon so favorably in 2-3 years time. And I'm interested to see kind of what happens in the labor markets when that happens, when there is a slight pullback, because it's going to be very interesting to see what all this means. I mean, I'm interested at the corporate level. What does all this wage inflation mean? It's hard to tell someone that they're making a third more than they were a year ago and then pull it back. I think that's almost an impossibility. So what does that mean for balance sheets? I'm interested to know at the individual level what these moves in the last 2 years mean, and how that projects out over the course of 15, 20 years, and if it was a net positive, to make a move in the last 2 years. So it's just interesting. It's an interesting time to be looking at how big organizations are navigating the labor shortage, navigating compensation. Companies are having to compete on so many different fronts. Compensation is just one, but companies have had to take down their profits to improve benefits, and they've had to take down profits to provide more programs and services. So it's just been an interesting time to run businesses and see how businesses are run. And the long-term implications are going to be really, really fascinating to look out for, especially as it relates to individuals and what moves they've made for themselves over the course of the last 2 years, and how that plays out long-term.